Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, we've got just a whole slew of economic data here, and the question for a lot of folks is, to what extent is that going to impact the Federal Reserve going forward here? We got a Fed meeting next week on the 7th, and then the meeting in December. What's the Fed going to do? Fortunately for us, we have somebody who does this stuff for a living. We actually pay him to do this stuff. Ira Jersey, he's the best on the street. He's our U.S. interest rate strategist. We appreciate getting a few minutes of his time. Ira, interpret some of the economic data we've seen recently, maybe some of the remarks we've heard from some of these Fed folks. How do you think the Fed's going to act over the next several meetings?
Yeah. So I think it's shifted actually over the last month or so, given the strength of the data. And in fact, this morning's personal income and spending numbers, along with the PCE deflator, the consumption deflator that we received, will allow the Federal Reserve to be somewhat less dovish than they were at the September meeting. So our expectation now is that the Fed will cut next week. The market's fully priced for it. The Fed, they don't want to lose face. They just cut 50 basis points, so I think that they'll cut again. But the big important announcement is probably going to come during the press conference, where Jay Powell will kind of maybe not so subtly hint that the Federal Reserve might skip the December meeting and then reevaluate if they're going to go in December. So the market's not fully priced for that yet. The market's still priced for better than even odds that they're going to cut in December, but I suspect that those odds will come off pretty dramatically.
Now, that would be definitely an interesting thing to see.
That'll make the press conference, of which we'll have, Michael McKee will be there, and he'll be there and he'll get the full reporting.
Yeah, but as we're looking at these numbers that came out, I mean, there's still a bit of stickiness in terms of the core PCE, but overall PCE does seem to be trending lower, which of course we do know that consumers, investors, and the Fed want to see. How are you kind of viewing this data and the importance of it, especially since we do know that this is the Fed's preferred measure for inflation here?
Sure. So the Federal Reserve, and Jay Powell's even mentioned this in some recent speeches, that they focus on headline PCE deflator, right? That's their preferred measure. That's at 2.1%. 2% is their target. So, call it done deal there. But as you noted, the core inflation measure is meaningfully higher than that at 2.7%, which is largely driven by housing prices and the year-on-year change in housing prices, which still continue to be relatively sticky. But even that started to come off a little bit. And the big thing that I look at is some of the details and components in here. So, as soon as this data came out at 8:30, by 8:35, I was updating a bunch of the charts and nerdiness that I do in parsing out this data. And if you look at services inflation has been the single biggest driver, and that's been slowing pretty significantly over the last couple of months. And compared to a year ago, it's much lower, in fact, or slower, I should say. It's still growing, right? Prices are still going up. They're just going up a lot less than they had been before. And I think that the Federal Reserve is going to look at that and say, okay, look, if services inflation is actually rolling over and not going to be as big of a driver of inflation going forward, then that means that over time, core inflation will continue to come down. And, quite frankly, if core inflation is sticky at 2.5%, that's fine for the Fed. The Fed just doesn't want that to go up, right? Like, call it over 3% is unacceptable to the Fed, but, kind of hovering around 2.5% would be absolutely fine as long as you have goods prices that aren't going up very quickly at all, which is the other aspect of this, right? Which is why the election next week might actually have some impact, but not in the near term. It's much longer term impact, like do tariffs increase prices of goods, which goods have been one of the bright points of the inflation data of late.
All right, Ira Jersey, thank you so much. We appreciate that. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Appreciate getting a few minutes of his time.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Geetha Ranganathan. Geetha is the media analyst at Bloomberg Intelligence. He's based down in Princeton, New Jersey. Geetha, a lot to talk to you about today. Let's start with Comcast. Was this announcement by the company that they're considering spelling off their cable networks, was that expected by the street? And do you think it could be a good move?
I'm not so sure if it was expected by the street. I mean, we've always known, especially from a timing perspective, Paul. I mean, we've always known Comcast is itching to do something when it comes to M&A, and especially as far as their NBC media business is concerned. You're absolutely right in pointing out that this is a segment that has been affected very adversely by cord cutting. They're losing about 8 to 10% of their subscriber base every year, and that has kind of really weighed on, both advertising revenue as well as distribution revenue, which is affiliate fees for the cable networks. Remember, they have some very good cable networks, whether it's USA, whether it's the Golf Channel, whether it's MSNBC. But again, across the board, we've seen ratings pressure, we've seen advertising pressure, we've seen affiliate fee pressure. And so this is them basically saying, yeah, we need to do something about this, and we need to kind of spin this because this is really weighing on the valuation of the entire company.
Geetha, talk to me about Peacock. What's going on there? Is that a good business for the company?
So Peacock is, Comcast and NBC solution, streaming solution, and they've had some pretty good success. But again, if you're kind of looking at streaming as a subscriber scale game, Norah, well, they're really far behind. So they have about 37 million subscribers. I mean, every time they have a sports a programming boost, either with the Olympics or with an NFL playoff game, so they do kind of get those little bumps. But again, when you're comparing Peacock at 37 million subscribers to Netflix at 282 million, I mean, there's just no comparison. So it's not a scalable solution, but it is a good solution nevertheless for Comcast at the time being.
I've been a big fan of Comcast as a stock for 30 plus years. The management family, the Roberts family there at Comcast, Mr. Roberts back in the day. What's the future of this company, Geetha? How do people look at this company? Because, their cable TV business, their entertainment businesses, as you talked about, the cord cutting, everybody who's got, what's the future of this company, do you think?
I think the future of the company still remains very strong, Paul. So yes, they are a vertically integrated media company. They have both distribution as well as content. Majority of their EBITDA, as you pointed out, comes from their cable connectivity business, 80% of their EBITDA. And that part of the business has been, suffering from a little bit of a slowdown because broadband subscriber growth has really been hurt because of a lot of competition from both fiber as well as fixed wireless access. But it looks like there might be a slight turnaround. So there are some green shoots there. And at the end of the day, while even if it might not be a big growth business, I think it will be a stable business, and Comcast will be able to drive pretty healthy, both revenue gains as well as, low to mid-single digit EBITDA gains. Now, where, kind of investors really struggle is what are they going to do with the NBC asset? And yes, again, now it looks like they're evaluating some strategic options with the cable network business, but the studio is doing really well. And the theme parks, while suffering from some softness recently, will kind of see a reversal next year because they're opening one of their most ambitious projects ever in Orlando, Epic Universe, which will basically double their footprint in Orlando.
Yeah, I saw going through the airport recently down in Orlando, tons of advertising for this new Universal Park. And we saw some people, where did I see? We were at the hotel, Alex Steele and I, for something, and the people came down. No, they came from England just for the Universal Parks to Orlando.
Wow.
They didn't go to the Disney properties, which
What a
I was
draw.
fascinating.
Let's just back up. They were in separate rooms, and it was a business trip.
Business trip. Thank you.
I want to clarify.
Thank you, Josh.
Thank you that for
Thank you. Well, I wanted to move over to Peloton. I mean, of course, we did hear that news today that Ford's executive, Peter Stern, will be the next CEO of Peloton. They're really hoping that he will lead a turnaround. Of course, we know that this has really been a struggling company here. What has been the general sentiment? I mean, I'm seeing shares up substantially more than 20% in trading today.
Yeah, so I mean, the sentiment obviously has turned, and it has shifted to a more positive sentiment. Of course, with this new announcement of a CEO, I think the street kind of now really expects an articulation of kind of this the future strategic direction for the company, the vision for the brand, and how this new CEO is going to go about accomplishing that. But in the interim, even as they've kind of waited, for this new person to come on board, they've done a lot of things to kind of right the ship. So one of the biggest problems for Peloton, along with the softness in demand, has been a very kind of bulky cost base, which led to a lot of losses, a lot of cash burn, and they've really kind of righted the ship there, if you will. So we saw them posting profitability that came in well above what consensus was expecting. They've raised their guidance for adjusted EBITDA for fiscal 2025. Again, free cash flow is positive. So a lot of things to cheer. But again, I think the ultimate question for this company is, what is really the end game for Peloton? Will they have sustainable demand? Will they have sustainable free cash flow? Or is this just going to be kind of an M&A play?
So where do we go from here? Because you mentioned the free cash flow, and I'm looking at the FA function on the Bloomberg terminal, and the company forecasted for the first time in many, many years, maybe in its history, free cash flow positive in their fiscal 25 and even more free cash flow positive in fiscal 26. So it sounds like maybe, as you mentioned, they've righted the ship, but is this a standalone company, Geetha, or do investors feel like it could be part of something bigger experiential company?
I mean, Paul, there have been so many rumors about Peloton kind of ultimately being, this attractive M&A candidate, whether, it could make sense for an Apple, whether it could make sense for Amazon. Over the past few months, there have actually been some rumblings about whether it makes sense for private equity, especially with all this focus on cost cuts. So that's still kind of a little bit of a wait and watch. I'm not so sure it really makes sense as a standalone company unless this new CEO has some really grand vision in terms of introducing new modalities, in terms of really resuscitating the demand, because we're seeing subscribers kind of fall off quarter after quarter, and that really is the question. Yes, they are going to be free cash flow positive in 2025 and 2026, but that's really more by right-sizing costs. At the end of the day, they have to grow their top line, and that is where we're kind of still struggling.
All right, Geetha, thanks so much for that. Geetha Ranganathan, she covers all of the media space for Bloomberg Intelligence. She's based in our Princeton, New Jersey offices.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alalu Aganga joins us. She's the U.S. Chief Investment Officer at Mercer, joining us here in our studio. We appreciate you coming in. What do you make of this market when you talk to your clients? Because people are telling me we got an election next week, so I think that's kind of important. We've got earnings coming out like crazy this week. What's kind of the message you go out to your clients with these days?
Right now, hang tight.
Hang tight.
Hang tight. So, when you think of the elections, at least for us, our clients, as we say, they're long-term investors. There are a couple of things, though, with regards to elections that are top of mind. And the first is just uncertainty, and it's uncertainty around where you allocate capital. Because for us, if you're tying up money for years and years and years, and a policy change happens, that could affect your investments. So things like infrastructure, clean tech spending, those areas that were attractive during the Inflation Reduction Act, if any aspect of that changes, that's one, issue. And then another thing that is top of mind for clients is the potential for tariffs. That is a big topic right now, depending on where that goes. And it's either that'll increase your spending, if you're an operating entity, those types of things. And the impact on the portfolio is my portfolio generating enough? So top of mind in those two categories.
So when we think about next week and the potential outcome, are there any particular sectors that you're keeping an eye on depending on either presidential win?
Well, we've actually most recently taken risk off the table. We were overweight equities just broadly going into these types of events because of the volatility and uncertainty. It's a close race as we know it. So we've moved back to tactically neutral across the board. So we're at market weights, no real sector, no real geographic overweight going into this.
Fixed income, I mean, I don't know what's going on out there. I mean, I got a Fed is cutting rates, and I've got yields going up, so I don't know. What are you doing in fixed income space? Are you sticking with the treasury market? Do you take some credit risk? How do you think about it?
When people throw out fixed income broadly, it plays like 5 roles in a portfolio, right? So diversification, income, inflation protection, you name it. For us, when folks are thinking about fixed income, they're really thinking in terms of diversification. And then we're encouraging clients to look more at non-traditional strategies, right? So where rates are today, hedge fund strategies, if you build a well-diversified one, can actually really be more impactful in your portfolio than your traditional fixed income. Treasury correlation is negative 0.3 to 0.5, but the rest is actually 0 to positive, positive correlation to equities. Where rates are today, it has a direct impact on companies' bottom lines and funding and those types of things. So long-short strategies for hedge funds do well in this type of rate environment, even though it's decreasing. The trend-following strategies are doing well as well. So those are some of the things that we're talking to clients about if they're looking for diversification that they traditionally go to fixed income for.
Mm-hmm. I mean, how are you thinking about data right now? Of course, we had PCE coming out this morning. And when we think about it this year, we've really seen a broad rally. Of course, we're seeing a breather today, but we do have the S&P 500 up 20% year to date. So how are you really viewing this data, inflation? What is the consensus right now?
So for all the data points that are going in, we're piecing everything together to make the case, and we've been saying this for some time, around a soft landing, right? So if you start with GDP data, consensus was 3.1. It came in 2.8 for the quarter, but that's still pretty decent. That's strong. Then if you go into the inflation number, CPI, I think it was call it 2.4 for September. Non-farm payroll at the start of the month, so the September numbers was 2,500 or something like that. We've got numbers out tomorrow, so we'll see. But those three, coupled with the 50 basis point rate cut that happened, right? All of the data points are still consistent with the fact that we are gently landing.
So when you're thinking about data more broadly, where is your focus? Are we looking at jobs data or inflation data? It seems as though there's been a shift more recently.
It's a mosaic, because what we found is there's just no one data point that has predictive power for you from an investment standpoint. We've tested a number of different things. So it's both piecing the data together, and then what is the interpretation for that point. We also look at commodity data, right? Right now, geopolitics is somewhat front and center across the board, and that affects commodities. So we're watching that as well. So what we do gradually is, as each piece of data comes in, we start getting a sense for where the trends are going, and using that in addition to the earnings that are coming out. For example, we're looking at where earnings forecasts are. And if you think of the U.S., other than a small handful, the earnings growth numbers aren't, fantastic. The Magnificent Seven maybe, but for the rest, not so much.
So what do you think this market needs to see out of earnings? We're kind of in the middle of the earnings season here. Do we need to see it feels like we need to see big beats, because we got the market selling off, NASDAQ off 2% today on Microsoft and Meta numbers I thought were pretty good, but maybe just a little weak, and that's enough for the market to sell off.
It's still tech, though. If you were to think of the broader, we need to see it expand beyond a specific category to be, more excited than we are. Now, granted, we're sitting here with the S&P where it is,
exactly,
right? So
exactly.
the question is, how consistent is it, and can it last?
Do you see this rally lasting? Do you see it having further to run?
The thing about tech is that it continues to push the frontier, right? So as you have more CapEx, more data, more innovation, never say never, those that bet against that has surely been wrong. But we will say, looking at valuations relative to history, we are at extremely stretched levels. So back to how we allocate capital for the longer term, if we're looking at our forward-looking capital markets assumptions, for example, where we see longer term equities, especially U.S., and more firms are coming out with numbers that are not as high as they have been, right? So it's what we've seen the last decade. Do we expect this magnitude going forward? We haven't seen it, and we're not convinced.
How about alternative investments? How do they figure into your outlook these days? I'm surprised when I go to see and visit with registered investment advisors representing their institutional clients, that their clients are asking for it, and they want something more than just 2 to 5% allocation. Kind of surprises me, gets me a little nervous. But how do you guys at an institutional level think about alternatives?
So the first part about it is assessing your liquidity profile. Even you're talking about individuals, but if you start thinking, how much cash do I need? Mm-hmm. As we talk about cash planning with a number of organizations, especially operational ones, do you have enough cash for the first 1 year, 18 months, maybe 2 years of operations? Then beyond that, let's start thinking of a waterfall. So where primaries and private equity has the longest tail, maybe private credit is 6 years, 7 years. Mm-hmm. Can you withstand that? We talked about hedge funds redemptions as quarterly for some. So it's more building out that profile. Real estate value add funds are 7 years. So the place for private investments is along the waterfall for liquidity. And that's really how we encourage clients to think about it. And then more importantly, what type of role are they playing in your portfolio?
Is now the time for small caps? How are you all thinking about small caps right now?
I mean, we have had some decent luck in small caps. However, the breakout of small cap companies, especially today, it has a decent number of what we call non-earners, right? So like the growth stories that will grow into some of these multiples and valuations. Small cap stocks are also levered towards rates and are pretty sensitive in that regard. So rates coming down, okay, I guess it's good. But where we've seen the delivering of the earnings has been more large cap. However, from an active management standpoint, that's where you need the active managers to sort of sift through the index to be able to find those types of opportunities. So with active management, yes, just as an index could be a bit more challenging.
We are seeing, again, the NASDAQ off 2% today. I mean, does that tell you that, are you concerned about the valuation of this market here? Because again, I thought Meta and Microsoft numbers were pretty good, but boom. Sell them.
So we are definitely not excited about valuations here.
Okay.
It's elevated. No matter what historical metric you look at it, it's pretty high. Off 2% today is definitely not enough to be able to bring it back. So the valuations are elevated. Is this where we would be overweight today? No. As I said, we're neutral.
Okay.
So valuations are elevated. It's one of the additional data points that we're looking at as you evaluate across your other portfolio. Are there areas that could be more attractive, hence private markets?
Yep, very good. Olala Aganga, thank you so much for joining us. U.S. Chief Investment Officer at Mercer, giving us some thoughts on these markets.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
It is never a good news day for a company when they pull their guidance. Not bueno.
Not what you want to hear.
Investors don't like that. And just ask the good folks at Estee Lauder. They pulled their guidance. They got some challenges in their business. They called out China. But the stock falls the most on record. We're now down the lowest level since 2014. So real challenging day for Estee Lauder. It goes to the whole luxury space. We're seeing a sell-off in the luxury space. So when you want to talk luxury goods, there's only one place to go to. Deborah Aiken, luxury goods analyst for Bloomberg Intelligence. She's based in London. She knows these companies backwards and forwards. Deb, what's your take on the news coming out of Estee Lauder today?
I think it was another case of outgoing management making promises in the market and the investors starting to really believe it after we saw some improvements coming through from the restructure program. So how this stood, we know Estee Lauder are really heavily exposed in Asia Pacific, particularly in China and in travel retail across Asia. In skincare, they're more exposed than any of the peer group. And though we've had negative comment and comment in the marketplace from the peer group that China is not doing so well, that it's even down versus where it was from a couple of months ago, the view really was that Estee Lauder in August had said, along with the others, that it would be they hoped it would be a slightly improving market, and that just hits them hard. They have a new CEO coming in January, and so they've given Q2 guidance, which is way below consensus expectation on EPS. And also a -6% to -8% on organic sales growth for 2Q when the market looked for flat. So there's a lot to do, not just in Asia, but elsewhere.
I mean, for this company, the results were significantly worse than expected. I mean, we saw the guidance withdrawn for the full year guidance, and then also a 47% dividend cut. And I'm seeing shares of the company down 52%. But when I'm looking at Wall Street analyst ratings, we're seeing 7 buys and 25 holds and 0 sells. So I'm curious there. I mean, is there still some hope left in the market in terms of this company being able to see a turnaround for there to be 78% of Wall Street saying to hold, but 0 people saying to sell?
Right. So we've seen it's been 2.5 years in the making that we're looking for this transition and return to growth. We've seen margins move from mid 20% down to low teens, down to single digit, and that's where we sit today. And the expectation was really because of the exposure into Asia, particularly China, that we would see some improvement coming through, and that we're on the precipice of this. And we're just not seeing that. So I would imagine, there'll be a rethink on where we go. And certainly it's about structural fix. It's about really the new CEO coming in with a new program, which is really, I must say, we are seeing some improvements from a low base on gross margin. Some improvements should come through on operating. There are new, much more social media type events taking place. They're doing very well with some of their brands in the US on Amazon Beauty online store. So that's starting to come through. But there's so much to do. And one of the big things is to reposition themselves so they're not as exposed in Asia in the long term. That's what the investor has to decide in terms of the timing on that, on where they really see the base.
And also pressuring the stock, I'm sure, is the fact that the company did cut its dividend. It says to create financial flexibility for its incoming leadership team, but clearly the dividend cut's impacting it as well. Hey, Deb, as a financial analyst, you look at all the levers on revenue, the levers on costs. Where do you think this new management team should be focusing? Is it repositioning their brand, or is it just simply doing it more efficiently, cutting costs, maybe?
And when we think about it, in terms of the cost structure, there is some movement they can get out of there. So they have a big program running, which will cost up to 700 million. And in the end, they're looking for benefit of 1.1 to 1.4 billion. So they're guiding to the top end of that cost cut. And I would imagine on the back of that, they come somewhere near the bottom end when it comes to the savings they get over the program, probably not to 26, but into 27. So there are some savings to come through. But I think it's about repositioning what they have, being closer to the market, understanding the consumer better, pulling in a younger audience. They're doing it small steps, but then the competition is getting ahead. So there's a lot going on. It's more about talking to the market, to the consumer, and building up from the top line down.
All right, very good. Deb Aiken, you are an expert on all things luxury. Deb Aiken, she's a luxury goods analyst for Bloomberg Intelligence, joining us from London via Zoom.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Mandeep Singh darkens the door. I think we have him to blame maybe for the sell-off today. I thought the Meta and the Microsoft numbers were pretty solid, but
we need to hear his defense.
Concerned.
I'm curious.
Let's see what he has to say. Mandeep Singh, Meta, Microsoft, just summarize kind of what you think the market's reaction is today to these earnings. We're seeing a sell-off in those names and in the broader market. How do you view those tech numbers from last night?
Yeah, I mean, the setup was very different from Alphabet in the sense that expectations were much higher. And in this case, I think with Microsoft, at least they quantified the AI services contribution being $10 billion by next quarter. So that's huge. Still, when it comes to Azure, the fact that growth is not accelerating like we saw with Google Cloud, it makes you wonder, if CapEx is growing 50%, why is it not translating into faster Azure growth? Even though 33% is a very solid number, but you want to see that acceleration, which we saw with Google.
So, coming into this earnings season, when we were thinking about the market more broadly, expectations, it seems as though the bar was a little bit lower, so it should be a little bit easier for companies to beat. How are we thinking about tech earnings season as a whole, and how much we expect it to really drive the S&P 500's gains?
Yeah, look at the first two Mag 7. With Tesla and Alphabet, the bar was much lower. They came out with very good numbers, and you saw the stock reaction. In the case of Meta and Microsoft, the expectations were higher. And I would say Meta is somewhat different in the sense that they have their own large language model. They have their lead when it comes to, generative AI, but they don't have a separate AI revenue line like you see with, Microsoft or with Alphabet. And that's where, if they say, CapEx is going to significantly increase for 2025, without really quantifying how significant it will be, whether it's going to be 20%, which is the consensus number, or 30% or 50%, nobody knows. And that's what I think created that uncertainty around Meta's CapEx spend. And we saw what happened in 3Q of 2022, where they had a very similar print, but they actually quantified that significant, and the stock dropped 20% after that. So clearly there is some nervousness and uncertainty around their capex spend.
Meta off about 3% here today in trading. Looking at the shares of Microsoft, off about 5.8%. All right, after the close tonight, a couple more of your names, Apple and Amazon. What should we be looking for each of these names?
I mean, again, the bar is much lower for Apple. So talking about, how Tesla and Alphabet did well, the bar is lower for Apple. The problem with, I think, Apple is, in terms of catalyst, they don't really have a catalyst for, a big beat and raise, because China and, other markets, you're not going to see a big Apple refresh cycle that everyone has been waiting for. Apple Intelligence is a driver, but it'll be more qualitative. You're not.
What is Apple Intelligence again?
Oh,
I got Bloomberg Intelligence. I know what that is. So they copied us, basically.
Sounds like it.
So what is it again? Is that their AI?
Exactly. It's
I
their
get the whole
AI
AI,
chip inside the phone. So they don't rely on NVIDIA GPUs. They actually do it on their chip, which resides in the phone. And that's their Apple playbook. They vertically integrate. They don't really rely on anyone else. And it's taking time to, really drive that top line.
So what's going on at DoorDash? All right, I know DoorDash, we have Uber Eats.
I don't DoorDash.
See, I Grubhub, you forget I'm a premium member.
Oh, I didn't. This is the.
Maybe I shouldn't have said that on air.
All right, I'll let you. I won't
just learn to cook, Norah.
I should cook more. I'm working on it, guys. But how much market share does DoorDash have in comparison to, say, its competitors Uber Eats and Grubhub?
I mean, they are a category leader when it comes to online delivery, and I think what they've done successfully is to expand into adjacent markets without spending a lot on acquisitions, which is what Uber did, and it hurt their margins for a while. So in the case of DoorDash, it's been mostly organic, and now this partnership with Lyft. I mean, I think Lyft needed it more than DoorDash, but it does help, DoorDash being that category leader in the delivery, and now getting its foray in ride sharing.
I'm looking at shares of DoorDash up 57% this year.
Yeah, just amazing. I mean, it's got a market cap of $64 billion.
It's an amazing management team.
Is that right?
Really, you listen to the call, so much clarity. They do what they say on the call, and it's just, I think they've built that credibility with investors.
It's, offspring number 4, John, in college, saw a couple DoorDashes charges on the credit card.
I flipped out.
I stopped. The card was frozen for a week. And I said, no, you get off your keister and walk over to McDonald's and get your quarter pounder with the whatever.
With these share gains, maybe I need to switch to DoorDash. Maybe we leave Grubhub.
All right, so put it into context for John Tucker, because he's thinking about this food delivery business. Uber Eats versus DoorDash.
I mean, the playbook here is to do everything in last mile delivery and have you pay, $10, $15 subscription fee like your Amazon Prime. But Amazon Prime isn't catering to, ride sharing and food delivery. So that's where they want to be that indispensable subscription, that monthly subscription that you may have to pay.
And Norah, you do this.
Okay, but listen, Grubhub, if you have Amazon Prime, you get the premium membership for free. I started it out as a student years ago, and then it transitioned into Amazon Prime.
And once they have your credit card number, the only option is to cancel the card. You can't just freeze it because they'll keep charging it.
Exactly. There we go.
I made the mistake of actually trying to call them and complain.
All right, Mandeep Singh, he covers everything in the technology space.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We talk a lot about AI as a big driver for not just the big tech stocks, but just for the market
Everything
overall,
at this point.
it seems like. But there's downsides, and there's concerns out there. And I think back to the writer's strike in Hollywood earlier this year, and one of the big issues for them, in addition to getting paid more, was protections from AI. They want somebody coming in, some AI bot writing a script for the next show.
No, thank you.
It's a big legal issue. That's why we like to talk to smart people like Rania Setholm. She is a managing partner for Setholm Law Group. Rania, let's talk about AI and music. Can AI create music?
It can, and it has. I don't
Really?
know. I don't know if the listeners followed this story, but Ghostwriter, which is a great name for this quote-unquote artist, created a song using Drake and The Weeknd, although I don't know what The Weeknd's calling himself right now, but at the time, The Weeknd's voice, and there was obviously no permission granted by these artists, and he created a song called Heart on My Sleeve. Whether or not the song is good doesn't really matter from a legal perspective. And that's the scary part with AI. It's not just a learning tool. We hear about it in books and scripts, reading and then creating overly inspired text. Now, AI is learning your voice, your tone. We already have deepfakes out there, but now they're taking away somebody's livelihood. And then, God forbid, the messaging is not what the artist intended. It can be a big mess. At the same time, the Beatles just came out with a new song, and they were able to isolate John Lennon's voice in order to create something new. So if you're using AI in music to enhance something that you own or you have permission to use, that's fantastic. But from a legal perspective, we have laws you have to follow, but then we have just regular decency and morality. And perhaps we can write a script for that in case people don't know about it.
Definitely. And it's funny that you brought up the Drake situation, because that's what I was immediately thinking back to. I know when Drake and Kendrick Lamar were having this back and forth, that Drake used Tupac's voice as his synthetic voice through AI.
Yes.
What can you do about this? What is the resolve here?
I mean, unfortunately, you can't peremptorily stop somebody. I mean, yes, you can have a contract that tells someone you can't use my voice or you can't use this estate's, property. However, we really need to explain to people what they can and cannot do legally, because the law allows you to protect yourself contractually and then, post problem through demand letters and litigation, but that can be very expensive. Perhaps, Drake can afford that, but maybe new artists cannot.
So what are you advising your clients? Like, if I'm a new artist and I'm signing a contract, I now have to have language in there that says you cannot take any of my content, my voice, my lyrics, my anything.
Yeah, so we do work on a lot of releases for celebrities, quasi-celebrities, artists, you name it. And the language is to be extremely broad, right? You're doing a show like I'm doing this show, and you have unfettered rights to use a snippet of this program, the entire program, etc. So now we're adding that if AI is being utilized, first of all, we want to see information relative to how it's being utilized. Are you using it to enhance in case I sound a little scratchy or I have a lot of ums? Or are you going to use my voice and put me on some other show I don't know about? So we're tightening the language a little bit and asking beforehand for the company's policy with respect to AI. And if you're dealing with a large company, like Bloomberg, that's relatively easy. However, it's impossible to peremptorily stop individuals who are just really great at using technology, who may be somewhat anonymous.
So how are some of the big dogs like Universal, Sony Music, Warner Music, how are they thinking about this? I mean, especially if you think about it on a more drastic scale, could this at any point begin to threaten music sales if somebody else can just make a song using this person's voice on their own?
I think it threatens more the artist. So, we went through something similar about who owns what with Prince, right? At one point in time, he couldn't use his own name because he didn't own his name, and he didn't necessarily own the music that was produced under that name. So a company like Universal, Music could, I don't know, but could have verbiage in their agreements with the artists that say, we essentially own your voice. And if that's the case, they could create new works using their voice. So it's very important for whoever it is that's a creative to protect the essence of who they are.
I was always shocked as a sell-side research analyst. I didn't own any of the content I created. I didn't own the earnings models that I created, which are the backbone of my franchise and any analyst's franchise. So when I would leave job A to go to job B, my models were on a floppy disk that I took with me, which effectively was illegal.
Yes, that is correct.
And I went to the next firm the next day and loaded those same models up, put a new name on top of it, and there I'm off and running. But this is taking it to the nth degree.
It is. Thank you for telling me only about past crimes, because I can't help you with future crimes. Yes, it is illegal, and oftentimes, depending on the rank that you're in the organization, they'll make you sign some kind of, waiver or release. Not a non-compete, just a waiver and release of whatever it is that you've created, and they call it a work made for hire. And then if you're going to another large institution, in their offer letter, they likely have some verbiage that says, you promise not to use any material that you have no authority to use while you're here, because they don't want to get in trouble, because they don't want to get that continuing obligations letter, which is a fancy term lawyers use to send a letter to the new company and just say, hello, beware, we think that you may have information to which you're not entitled, so think twice about hiring X or Y.
Right. With about a minute less, will the music industry face any sort of job displacement from this?
I think so. I think, music producers really have to worry. The artist now uses the producer to help make the song, perfect, whatever that means. But they may not need these producers if they have the right technology. They can just use the AI producer, and that's a very different use of AI, and that use of AI is not illegal, at least not yet.
All right, I mean, we're seeing it all over content, again, from the writers in Hollywood to now music to everything else you can think of. I think it just feels like anything where content is being created.
Any industry at this point.
AI can go in there and
even
do it.
Mine.
So, yeah, I have to see. Ronnie Sedham, managing partner, Sedham Law Group. We always love talking to Ronnie.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.